Hi, everyone. Thank you for joining us for our discussion today with updates on the markets as of the midpoint in 2023. Let me start by introducing the members who are going to be speaking today during the presentation. Myself, Jennifer Myers, President of SageVest Wealth Management, Eric Stein, who is a CFA who supports our company in terms of investment research. He's with East Bay Investment Solutions, and Ryan Albritton as part of our team. He's a financial advisor, CFP, and definitely involved in the investment functions, as we all are at SageVest Wealth Management, and Kathy Jaquette, who will be helping as a moderator of today's presentation. To that extent, just as a to let you know, there will be the ability to enter questions that we can either discuss if they're relevant to the current topic throughout the presentation or the end. If you would like to submit a question, please use the Q&A, questions and answer function, not the chat function, as part of today's presentation. So with that, I'll move us forward. Two quick disclosures here for our firm and for East Bay, that just to remind you that we're not presenting investment advice to anyone as part of this presentation, or tax or legal advice. Okay. So as part of today's discussion, we're going to be covering a number of different topics, including the current market environment, a look at the economy as of current, how the economy is relevant to investments and considerations, some current hot or buzz topics that are going on, and then looking forward, and as always, developing a solid investment approach. So we'll start off by looking at the current market environment, and we'll talk about some of the positive signals that are out there, as well as, there's always things in the headwinds of, areas of potential concern. So we definitely like the positives. We'll start there. A top item is that inflation has been, a problem for consumers, for the markets for a while. We are starting to really see inflation ebb, and we'll look at, how inflation has declined a little bit later in this presentation. The fact that despite inflation, the economy does continue to look strong, and that we're not currently in a recession. We will talk about the fact that, it's still potentially out there, but, we're not in a recession and things are strong. As part of that, the labor market also is very strong and has been persistently strong, that we thankfully averted the debt ceiling crisis or default, which, did create some angst and certainly some headlines, but fortunately, we resolved that. And as I mentioned before, that the unemployment rate is remaining at an impressive level of 3.6%. As I mentioned, there's always things out there to be considering. Our inflation rate has really come down quite a bit, but globally, inflation is still persistently high. As an example, the European Union, we're seeing inflation coming down. It's come down from above 8% down to 5.5%, but still not as far down to a palatable level as what we're seeing here. That we do have an inverted yield curve where short-term interest rates are higher than long-term interest rates, which is not the norm in the interest rate environment. It can sometimes be an indicator of a potential recession. And the fact that U.S. large cap stocks are really being driven by a few different names. I will add to that that it's not something new in the marketplace. So it's something to look at, but it's also not something that is relatively, of significance right now. The fortunate news is there's been a pretty significant turnaround in the markets and a number of other indicators. Last year, as many people probably know, was a miserable year. for the markets, with bonds, stocks, everything being down in double-digit territory. This year has been a distinct reversal, whereas as of June 30th, bonds were in positive territory by about 2%. The S&P 500 up just shy of 16%. The NASDAQ, which is predominantly tech and growth stocks, down 32% last year, up 32% this year. Mid and small cap stocks up 8%, and international stocks up just shy of 10%. Continuing that positive news, as I mentioned, inflation has come down from 9.1% as of June last year down to 4% as of June 30th, and we've subsequently come down to 3%. As we discussed, the economy is remaining in positive territory. We did have a little bit of a dip last year, but we're at a strong GDP rate of 2.2%, showing the economy is growing. The Fed has definitely been aggressive in increasing interest rates. That last year we were at an upper limit of 1.75%, now distinctly higher at 5.25%. And we'll see what happens later today with the Fed. But last year, they were still making pretty aggressive rate increases at 0.75% at different periods or intervals. The last decision was a pause or a hold, and we'll see. There is a high probability that we'll have another rate increase today, but distinctly expected to be much lower, if anything. In terms of the relationship to inflation relative to the markets, last year, inflation was a very strong driver as to why the markets were down. This chart shows the difference between how inflation has come down relative to how the S&P 500 has performed. And you can see in the purple, inflation has come down pretty sharply, as we discussed before, whereas the markets have really taken off. So it's really showing that as inflation is pulling back, it is definitely allowing a stronger outlook for stocks and the markets in aggregate, which is certainly good news for investors. This slide exemplifies that a little bit more, that it looks at a number of different market indices, such as the NASDAQ at the top, and then items such as crude oil at the bottom. The good news, again, is that there's a lot of green numbers and lines here showing that these indices are in positive territory and performing, generating positive returns this year, with only 2 at the bottom in negative territory, including China and crude oil as of June 30th. The market resilience that we've seen today, I think it's important to talk about the fact that even if you have some negative or concerning headlines, it does not always mean that you will have a pullback in the market. And the market has been very resilient this year, despite continued rate increases, albeit at a more modest pace. The fact that interest rates are remaining high, which means that borrowing costs are higher and sort of can often stunt interest in purchases. We certainly still have geopolitical concerns, and we did have the debt ceiling limit, which has now been resolved, but the markets did not have a significant dip when that was a hot topic, that they remain pretty resilient. So with that, I'll turn it over to Eric, who's going to take a look at some indicators for the economy.
Thanks, Jen. I appreciate the opportunity to talk to the SageFest clients today, so thank you for the time. When we talk about the economy, we're going to talk a little bit about the Fed today, and the 3 words that we're going to use are pace, pause, and pivot. So if we go back to 2022 and 2023, we've seen the Fed right now increase interest rates 10 times over that time period, anywhere between 25 and 75 basis points. So, the pace over time has been pretty significant in terms of not only the number of increases, but also the size of the increases. And obviously they're doing that to try and slow the rampant inflation that we had seen last year and part of this year as well. So what's interesting now is we're starting to see sort of a slowing of the pace. As Jen alluded to in the last meeting, they actually skipped a rate increase. The expectation is that today they'll announce another increase in short-term rates, but then they may skip another meeting or they may pause. That's really what we're trying to see in the clues that they give out today, is what their next steps are going to be, and it's really going to be based upon what the data is. So if you think about the pace, again, it slowed. The next step would be that pause again in terms of what they're stopping the increasing of rates. And the pivot is really just the idea of going to lower rates, which we don't expect to happen anytime in the near future, just because of, again, where inflation is today and where the economy is. What they're trying to do is really pull off a soft landing. So what they're trying to do is to cool the economy without causing a recession. And it's really difficult to do because their only really tool to do that in terms of the Fed is the short-term interest rate, the Fed funds rate that they've been increasing. So, if you think about what a soft landing is, again, you're cooling inflation without causing a recession. The opposite of that is a hard landing, where potentially they push rates too far, too fast, too high, cause a recession, possibly cause higher unemployment, and because essentially what they'd be doing is slowing growth. So it's a really difficult tightrope that they're having to walk here, simply because, again, they only have the one tool, the Fed funds rate, to do what they're doing. And it also takes usually about 6 to 12 months for their increases to actually be seen in economic data. So they're doing a lot of these things with sort of lagged information. So it's certainly an imperfect science of what they're trying to do. So if we think about what the Fed rate hikes are, again, you can see on the bottom how the Fed rate hikes have taken shape over the last year or so. And again, we're expecting another 25 basis points today. And again, that's because of what we've seen with inflation data. So the top just shows the lowering of inflation data over the last year. The blue line is what we refer to as headline inflation, which is normally what you'll see. It's a year-over-year number. It's the most prominent number that they talk about inflation. The orange line is what they refer to as core CPI, which is headline CPI, but it strips out energy and food prices because those tend to be the most volatile. So they try to get a different reading of what core CPI looks like. Jen, if you could advance the slide. Thank you. So a lot of what we're talking about today in terms of inflation goes back to, is there a recession? Is there not a recession? We're going to talk about two different ways to measure that. On the left-hand side, we're looking at some of the variables used to determine whether there is a recession or not. And as you can see on the right-hand side, you see a lot of green, some orange, some yellow, basically nothing red, which would mean, green is good, red is bad is the simplest way to read this chart. The recession alarms are just generally not sounding off, which is a good thing. If you also think about it in the terms of that personal consumption is about 2/3 of GDP, and consumers are still spending today, it's really just hard to say that we're in any recessionary environment today. The other measure of recession looks at just a back of the envelope calculation, that is GDP. And that is really just saying, okay, if you look at the 2 quarters of negative GDP, then a back of the envelope calculation would say we're in a recession. Why is that not a great calculation? Well, one, it's not really the true determinant of what is a recession or not. As we can see by Q1 and Q2, we had 2 quarters of negative GDP, but a recession was not called, it was not officially referred to as a recession during that period. And then also you have, Q1 and Q4 of Q1 of this year and Q4 of last year, we did not have negative GDP. So from this measure, it's clear that we're not in a recessionary environment from that perspective either. If we talk about unemployment, again, we've got unemployment that is historically low. We're at 3.6% unemployment, and that's been pretty consistent. So if you think about, again, what the Fed is trying to do, the Fed has what they refer to as a dual mandate. One of those mandates is full employment, which we could argue we're at full employment. We actually never really get to 0% employment. So 3.5% is pretty close to what we would call full employment. Their other mandate is stable prices, otherwise known as lower inflation. The challenge is sometimes it's difficult to have one or have both of them at the same time. Because if you think about it, if you have high inflation, what you're trying to do is essentially you raise interest rates, as the Fed has been doing. It may cool the economy, it may cool growth, it may cause higher unemployment, which is a bad thing. But if we don't fight inflation and we have low unemployment, and unemployment becomes much lower, it's more difficult for employers to find people for jobs because employers are essentially hiring people at higher wages, and we have this wage hike spiral, as it's referred to. Essentially, wages continually going up because employers have to keep paying more in order to keep their employees happy and keep them, employed in their business. So we were trying to balance these two things in terms of full employment and also stable prices. So again, a very difficult tightrope to be walked in that case. Now we're going to talk about the economy and how that's relevant to investments in general. So we've been talking a lot about recessions, and it's pretty common for us to get questions about, well, if the Wall Street Journal or some other periodical that you read is talking about the potential for a recession or the fact that we're in a recession, why are we not making investment decisions based upon the periodicals or the headlines that we're reading? And this is really why. If you think about it, the economic data that is used to call a recession is backward looking. Markets are forward looking. So the best way to explain it is in this one chart. So officially, there was a recession in December of 2007 through May of 2009. Unfortunately, if you're using the headlines of the newspaper to determine whether you should be invested or not, the recession wasn't officially announced till December of 2008. So if you just look at that blue box, you can see how poorly the market did from let's say late 2007, where the blue box starts, December 2007, till December 2008, when it was officially announced. You can see how poorly the markets had done. So if you were waiting to see when the headlines were announced, you rode that all the way down. And if you waited to get back into the market until it was announced that the recession was over, you can see from blue dot to blue dot, the market actually went up. So you rode it all the way down, but you did not get to ride it all the way back up because you were out of the market. So we just don't suggest trying to time the market based upon headlines, because frankly, it doesn't work. To show another example, I'll show you this chart as well. This is even more of a stark example. If you think back to March of 2020 was sort of prime COVID periods. We had a recession, again, an official recession in February to April of 2020, and you can see how the market did. Interestingly, it wasn't announced that we were in an official recession until later in June. So again, clearly after the recession had actually ended. And it wasn't announced that we were out of the recession until 2021. And you can see how the market did from the bottom of March of 2020 through the end of 2020. You can see how the market did. So trying to time these markets of being in a recession, out of recession based on headlines, we just think is a fool's game, and something that we just don't know anybody that can do successfully and consistently. So we just don't recommend it being done. And if we look at the yield curve, so Jen referred to the yield curve before as being inverted. So if you think about what a yield curve is, it's essentially what rates are of different types of bonds. You expect shorter term bonds to pay a lower interest rate than longer term bonds, just because you're locked in for a longer period of time and arguably have more risk. What we're seeing today is actually an inversion of the yield curve, where short-term rates, as you can see in that aqua turquoise line, on the left-hand side, that's the short-term part of the market, is higher than the 5-year, 10-year, 30-year part of the market. So it's just very inverted today. Sometimes people will look at an inverted yield curve and say that is not a cause of a recession, but it's correlated to recessions. But again, what we're seeing in the other economic data is that it doesn't appear that we're in a recession today. Doesn't mean we couldn't be in one in the future, but based upon where we are today, again, we're not seeing it. And what's, again, just interesting is how much higher rates are today than they were a year ago, which is great if you're a saver and a retiree. If you think about, your high yield savings account or CDs, a year ago, you were getting paid next to nothing. Now you can get, 5% plus in certain cases. Much more attractive yields today for investors and savers than you could have gotten a year ago. And if we look at treasuries compared to investment grade corporate bonds, which are referred, in this case, we're looking specifically at BBB corporate bonds. In this case, the turquoise line is the corporate bonds. That dark blue line is the treasury curve. You can see again that you're being compensated for being in corporate bonds, which are arguably riskier than treasuries, across the curve. So, the curve isn't as inverted on the corporate side as it is on the treasury side. But it also points out that there are very different curves around the world and in different types of securities. So there's a different corporate curve than there is a treasury curve. There's a different curve for municipal bonds. There's a different curve for the European Central Bank, for the Japanese Central Bank, the Australian Central Bank, and so forth. So again, having diversification among these different types of yield curves is an important part of how we think about investing. And this is another example of a way to look at that. So you can see where the yield to maturity is on several different types of bonds. And if you just look on the left-hand side of the curve, you'll see that short-term treasuries, you can see are higher, and that blue bar all the way on the left, 4.1, whereas intermediate term treasuries are 3.6. Again, in a normal yield curve environment, you would expect those to be inverted, reversed. In an inverted yield curve, the short term is higher than the intermediate term. It's the same place for the corporates in terms of that gray bar and that yellow bar. But again, talking about municipal curves, the following blue bar and green bar, 3.1 and 3.4, that short-term munis and intermediate-term munis, you can see again that intermediate-term munis are actually higher in this case than short-term. So that curve isn't as inverted or inverted at all, really, in that sense, versus the way treasuries or corporates are. So again, it just goes to show that there are different types of curves, different types of yields, but the moral of the story is yields are much more attractive today than they were a year ago.
And I'll just add to that, Eric, that the good news is that you're receiving higher income or interest on cash and CDs. Fortunately, the same is true in the bond market these days. So it's pleasant to be getting some income again.
Absolutely. And with that, I'll pass it off to Ryan to talk about some hot topics.
Thank you, Eric. Appreciate it. So I'm just going to go into a few hot topics, things that you guys have probably heard of in the news. It's been in the papers. AI, I'm sure, is something you guys have seen numerous times of late. Artificial intelligence.
Okay, it looks like Ryan is having some technical difficulties, so I'll step in here. So as Ryan was saying, we'll look at some hot topics. To Eric's point and our point earlier, you don't always necessarily want to follow what's hot today. One thing that we found was interesting, obviously AI, or if artificial intelligence is being touted as perhaps taking over the human factor in various areas of employment, the economy. What this looks at is the green line representing the Russell 3000 as part of the market's actual market performance as compared to the AI-powered equity exchange traded fund, which is a position where artificial intelligence is doing the stock picking versus humans. And you can see that the performance of the artificial intelligence has not been keeping up with the markets as a whole. So, clearly it is not that things have been perfected and that humans are necessarily being replaced in the current. Looks like Ryan's back, so I'll pass the baton and hopefully we'll continue to have technology work for us.
I am sorry about that, froze there. Can you hear me? Everything's clear now?
Correct.
Beautiful. So thanks for taking over that, Jennifer. Looking at Another hot topic, upcoming elections. It's that time of the cycle again. And what we really want to look at here is the impact on S&P 500 on equity returns. And we looked back at over 100 years of data at different administrations to really see what the positive and negative year-over-year returns were. And what we came back with was that no matter what party was in power, each of them experienced positive and negative returns at some point during their administration, with the exception of the Great Depression. So again, really what we want to drive home here is that no matter what the party, they both have experienced positive and negative returns. So don't want that to be a driver of, investment decisions. So developing a solid investment approach, we can go to the next slide here. Really what we want to focus in on is a number of topics, a number of data points or points that we have drilled home with clients over and over again. If you are a client, you've heard these before, but again, they really speak to what we think is most important when it comes to the investment landscape. And it's really maintaining a disciplined approach. I know that we mention that constantly. Avoiding market timing. If nothing else, we've seen that the last few years. With COVID, we had a rapid downturn and then a rapid recovery. Had a tough year last year and we bounced back this year. So really not trying to time the market, being in the market for the long term, not waiting for bad news to disappear. Oftentimes, if you are waiting for bad news to disappear, you're going to miss the recovery. We've seen it over and over again. So ensuring you don't do that. Chasing what's hot. So making sure that we're being careful, not chasing what's in the news, what's the, hot topic of the day. All goes back to really maintain that discipline of broad investment allocation, diversification. Concentrating on your long-term goals and objectives. And that really kind of goes into that last point as well. And integrating the financial planning as part of your investment decision-making. They really go hand in hand, which is why we focus on planning so much here. And again, just making sure that you are integrating that as part of your overall investment and decision-making approach.
And I'll just interject, a great example of not chasing what's hot is where we saw a very dramatic downturn in cryptocurrency. That it was quite the buzz for quite some time, and definitely not the buzz anymore. And, some very significant losses in that area.
Absolutely. And as I mentioned in the last slide, diversification, maintaining a broad investment portfolio. If you are a client, you've seen this before. If not, this is a chart that we love to look at. And it really gives a breakdown. In this particular instance, we're going back to 2013 on the far left side. And then as we tick to the right, we go to the next year all the way to 2022 on the right. And the various colors within the chart represent different asset classes. So you can see, for instance, here in 2013, you had US small cap stocks in orange, this lime green US large cap, the dark blue international, real estate, so on and so on. And it goes from the best performing on top to the worst performing on the bottom. And really what we want to drive home here is that different asset classes perform in different market environments, different geopolitical environments. So we want to make sure that we maintain broad exposure to various asset classes in order to take advantage of them when they are doing well.
And again, this exemplifies, what is hot one day could be at the bottom the next day, which we've certainly seen with emerging markets being top of the rung to bottom of the rung, real estate being top in 2021, coming down to bottom of 2022. And there are so many examples of that over time. So with that, we've covered a lot, and there may be some questions out there, and I'll transfer this to Kathy to see if anyone has submitted. And if you haven't and you have a question, again, you can submit those by using the questions and answers section or Q&A part of what should be available on your screen to submit a question.
Okay, I have the first question. What are your thoughts about interest rates relevant to the housing market and affordability?
It's a great topic today because a lot of people, whether you already own a house or are looking to buy a house, many times that is a conundrum today because mortgage rates have gone up from, the mid twos to around 7% today, which obviously makes buying a house a heck of a lot more expensive. It's different in different areas of the country, but around here we have, the Northeast area, we have seen more resilience in prices, which is good for homeowners, not great for home buyers. Part of that is because the inventory is so low that a lot of people who locked in mortgages in the mid 2% range are also feeling the pinch, even if they want to move. Sometimes they're even looking at downsizing, but the monthly mortgage payment might be more just because the interest rate is so much higher. We can never predict where anything is moving in the market. I will say that we've seen very high and rapid moves in Fed rates, and that's the current environment. We are not at a normal level for what the Fed puts forth, that they've really been trying to combat interest rates. So I can't offer a prediction, but I'd be hard pressed to think that mortgage rates will remain here long term, because we probably will see some easing. But I think you really need to think about your affordability if you're looking at making a move, and hopefully if rates come down you can refinance, but it's also hard to predict where the housing market is in terms of price structure. But that lack of inventory is definitely helping to support it's making inventory very tight, which is keeping prices strong. So to that extent, we may not be seeing a significant downturn in prices.
All right, my next question for you. Are T-bills a good investment?
I'll jump in and take that question, Jen. So if we're talking about T-bills, it really depends on what type of investment you're looking for. So we talked about the yield curve before. If you think about short-term treasuries or T-bills right now, they're yielding 5-ish%, depending upon the day, a little bit north, a little bit south, but 5-ish% for a T-bill, it's relatively attractive. If you're talking about sort of a treasury bond, which is a longer term investment, it's going to be a little bit less today, again, because of that inverted yield curve. The treasury bond can be actually a pretty good investment to be an equity, a hedge to equities, which we may own in some of our portfolios. And from a T-bill perspective, again, if you have a sort of a short-term investment, short-term goal you're trying to achieve, that can be helpful. But the risk you're taking is really reinvestment risk. And what we mean by that is, yes, you can get 5%-ish for the next 1 year. But if things change in the market, if the Fed decides to pivot and decides to lower rates, let's say rates are lower, below 4% next year, when you go to reinvest that 5% treasury that you have today, you have the risk that treasury rates will be possibly lower, maybe significantly lower in the next year when you go to reinvest. So if you're able to lock in at 4% or higher for something that's about 5 years, that may be more attractive for the long term because you have less reinvestment risk. So it really depends on what your time frame is, what your goal is. Certainly talk to your advisor about your overall plan, but it really just depends on what you're trying to achieve, but it can be a good investment, certainly for certain types of goals.
Thanks, Eric. And I'll just add to that also that, we did see last year interest rates yields, income went up, whereas interest rates went down, despite the fact that the Fed was increasing. So it's not always a slam dunk that interest rates are going to move in correlation with Fed rate increases. And, if we do see the Fed cooling down, which we have, and, if we do have a pullback in the economy, even if it's, a modest, God willing, soft landing, if we do have one, to Eric's point, you really could see those short-term yields come back, and it's a reinvestment factor. And again, not trying to time the markets, because while the short-term rates are compelling right now at 5%, the stock market, not that you should put everything in the stock market if you have a short-term need or, income needs, but, stocks have distinctly outperformed. So if you had gone to a pure safety valve, it would not be to your best interest in today's market. Kathy, any other questions?
That is all I have.
Okay, well, thank you to everyone for joining us today. Just as a reminder, SageVest Wealth Management, that we do provide investment advice as well as total and comprehensive wealth management services, and making sure that all aspects of your finances are working in support of one another. So with that, I will thank Eric and Ryan for helping to present today, and Kathy for helping to facilitate, and wish you all a wonderful afternoon. Take care.